Hello and welcome to youshallpass.com.
This video is about LOS 1, which is the CFA Institute's Code of Ethics and Standards of Professional Conduct, and LOS 2, which is Guidance for LOS 1. LOS 1 and LOS 2, together with the section on Global Investment Performance Standards, comprises about 15% of the CFA Level 1 exam. And of that 15%, the overwhelming percentage lies in favor of LOSs 1 and 2. So this is a very important topic to prepare for. You'll really benefit out of this video if you have a hard copy of the Code of Ethics and Standards of Professional Conduct with you right now, and hopefully you've gone through it at least once. If you haven't, then I suggest you pause this video and you scan through the hard copy and then resume. Alright, so what we're going to do here is assume that everyone has read the CFA Institute's Code and Standards, so we're just going to zoom through them very, very quickly here. We'll then give some background and context about the development, and then we will distill their essence into 6 very easy to use and simple to remember rules. We'll then work through all the sample questions in the curriculum readings, both to get you comfortable with the use of the 6 rules in exam questions and real life situations, and also to show that those 6 rules map 100% onto the CFA Institute's Code and Standards. So grab that hard copy and get ready. Well, the last few years have been rife with instances where the investment profession hasn't exactly acquitted itself with a lot of grace. And investment professionals have been accused of rampant greed, corruption, connivance, incompetence, stupidity, some of these, or even all of these. So one can actually be forgiven for wondering whether ethics has much to do with investments in the first place at all. To the CFA Institute's credit, however, none, if any, of all the people who acquired fame or who became notorious during these times, none of those people, if any, were CFA Institute members. So the Institute must be doing something right by placing so much stress on ethics and compliance straight off the bat, and then keeping that stress up throughout the exams and throughout the members' professional life. So, what is the CFA Institute Ethics Code? Well, basically it's an attempt to delineate first what not to do, both at an actionable level and also at a philosophical level. And then, where possible, it's an attempt to lay down what should be done and philosophies that should be followed in the professional life of a CFA Institute member. And to the extent that human behavior can be guided by words on paper, the CFA Institute Ethics Program ensures that number one, that CFA Institute members are required to and act with the highest possible degree of professionalism, integrity, and honesty, and number two, that the world knows about number one. Well, quite simply, no one likes being cheated, whether it be at the fish markets or in capital markets. For capital market participants, knowing that the people they are dealing with not just going to behave ethically and fairly, but also that they are required and bound to behave ethically and fairly. This will, it's going to build and deepen the trust of all concerned parties in the capital markets and improve the overall robustness and social utility of the financial system. If you analyze business or life, you'll realize that the most critical thread that weaves together all human interactions, whether it's personal or professional interaction or interaction between corporations, but the most critical thread is trust. Take trust away, and society as we know it will cease to exist. Trust is what allows for the free exchange of goods and services for consideration in fiat currency. Trust is what convinces investors to plunk down cash for the ownership of bonds and stocks. Trust is what persuades people to work hard for demanding employers and clients. And believe it or not, it was trust that lay at the foundation of your decision to watch this video. The more you look at the world, the more you realize that trust does indeed make the world go round. And what the CFA Institute is really doing is trying to build the trust that people and corporations can place in each other and in capital markets. When more people trust capital markets and each other and trust the authenticity of the information that they use to make business decisions, then caveat emptor, or the rule of buyer beware, starts to matter just a little less. And when that starts to happen, then risk premiums related to being cheated drop. The aversion to and the fear of not getting what you had bargained for is lowered, and that increases the number and confidence of people willing to do business generally, and also, for that matter, in capital markets. When more people and more funds feel confident of entering capital markets, it becomes cheaper to raise funds and easier to sell assets, and you have prices that trade at levels commensurate with the quality of what's being bought and sold. So generally, a more robust, responsive and flexible financial system, all because of ethical behavior and the trust that it inspires. Yeah. The CFA Institute can become aware of violations of the PCP in several ways. Firstly, there's the annual professional conduct statement, in which members must self-disclose any instances where their professional integrity or conduct may have been called into question. The CFA Institute can also take up and investigate written complaints about a particular member from affected parties in which the member is accused of having behaved in violation of the PCP. The CFA Institute can also spring into action on media reports about a particular member in which the CFA Institute feels that the member may have violated the PCP. And exam proctors can also file written complaints about candidates whose conduct they feel has been in violation of the PCP. The professional conduct staff is in charge of conducting investigations and assessing whether a member is innocent or guilty. Innocent members are innocent, and for the ones who are guilty, they can be publicly censured or warned, and their membership may be suspended or even revoked in severe cases. And for candidates, they may be barred from taking any further part in the CFA program. All assessments or punishments which are recommended by the professional conduct staff can be appealed by the member or candidate, in which case the appeal goes to the disciplinary review committee. So far, we haven't done much. What we've done is that we've stated the code and standards, and we've given some background and some developmental context about how and why the code and standards came into being. I suppose you're still holding on to that hard copy, and you tell me, looking at the code and standards, whether you can remember enough of that to be of practical use in exam settings. In real life, we have the luxury of time and also of the printed code and standards being at hand. But in an exam setting, we have neither. Therefore, what we're going to do next is distill the essence of the code and standards into the 6 rules that we spoke of earlier. And that distillation process is going to form the meat of the upcoming portions of this video. What we're going to do is determine the philosophical structure underpinning the code and standards, and then using that structure to serve as a thought guide, as a mental roadmap, which, if followed, will help you determine the response to any circumstances, a response that is in keeping with the requirements of the CFA Institute's PCP. The CFA Institute has the appropriately titled CFA Institute Code of Ethics and Standards of Professional Conduct.
Well, obviously, I am not the CFA Institute, although some sell-side folks do call me an institution to myself. But I guess that's just sell-side folks for you. Anyways, in honor of the incomparable Frank Sinatra, let's just call these the rules of my way.
The rules of my way consist of 6 easy to remember and simple to use rules, the first of which is coming up right now. Rule number 1 of my way says, this is the circle of life. Honor it. Do to others as you would have them do to you. Don't do to others what you wouldn't want done to yourself. And whenever you face a conflict of interest, disclose. If you Google this, you'll find that this is the golden rule, also known as the ethic of reciprocity, but without the bit about the circle of life, of course. That's from The Lion King. The rule itself is simple enough. Whatever you do in the circle of life, it impacts at least one and probably quite a few parties. So before you do anything, consider how it would make other people feel. In most circumstances, the best course of action for you to follow is the one that you would like someone else to follow if you were on the receiving end of their actions. And by the same token, if your action or non-action can be harmful to the legitimate interests of even one of the affected parties, then that's cause to refrain and reconsider. The last part of this rule talks about what to do when you face a conflict of interest. These situations arise quite often during investment work. For instance, an analyst at a brokerage house may want to issue a sell recommendation on a certain stock, but may be pressured to tone down his recommendation due to the house's own holding of that stock or due to investment banking relationships with that company. Or a fund marketing company may persuade its clients to invest in funds even if the funds are underperforming or may not be a good fit for the investor's portfolio. But the fund marketing company continues to pitch those funds to its clients simply because of the juicy commission structure offered by those funds. Or a credit rating company may feel compelled to grant an unjustifiably benevolent or a generous credit rating to some instrument because of the compensation involved in the successful issue and placement of that security. Or a fund manager may be passing on inordinate and inappropriate amounts of brokerage commissions to a particular brokerage house due to favorable, attractive soft dollar commission structures, soft dollar commission agreements with that house. So you get an idea of what a conflict of interest is. It's a situation where there's a primary responsibility and there's a secondary irritant, and the conflict arises from their overlap. In these circumstances, the required behavior is for the member to immediately disclose the nature of the conflict and then to perform her primary responsibility in as professional and objective a manner as she would have done had there been no conflict of interest.
You took your first pinch like a man, and you learned the two greatest things in life.
What?
Look at me. Never rat on your friends, and always keep your mouth shut.
Well, you heard the man. That's Mr. Robert De Niro in Goodfellas, and he's talking about confidentiality. CFA Institute members and candidates owe a duty of confidentiality and loyalty to their clients and employers. This means that, that whatever happens between you and your clients stays between you and your clients, or employers as the case may be. This also holds true even if they are former clients or employers, or potential clients or employers. The only information a member is permitted to disclose to anyone is that which the client or employer has expressly permitted them to do so. Other than that, no one need know nothing about nobody. The exception, of course, is when the disclosure is required by law, as in regulatory filings, etc., or when the information relates to something illegal going on at the client or the employer. In that case, regardless of whether the client or the employer is past or present or potential, a member is free to blow the whistle and talk, or to rat out the client or employer to the relevant authorities. This also leads quite naturally into the next rule of my way. Definitely do no evil, and upon witnessing evil, stop, talk, or walk. This rule is really about situations where the member's non-action may somehow aid or abet something less than ethical or illegal. In such circumstances, the first thing a member should do is to intervene and stop the illegal act. If that doesn't work, the member should red flag the matter, red flag the issue, and talk about it to whoever can force the illegal activity to stop. That can be a regulator or a supervisor at a client, or the member's employer or internal counsel. Anybody, depending on who's doing the illegal activity and where. And if the illegal or unethical behavior still continues, the member should walk. That is, dissociate from the activity to the extent necessary. That can mean ceasing further work on that particular client or project, or taking up work in some other department, or even switching employers. Anything to put distance between themselves and the illegal activity that they tried to but couldn't stop. And that bit about definitely doing no evil, well, that's kind of redundant, since the negative portion of rule number 1, that bit about not doing to others what you wouldn't like done to yourself, definitely implies and means that the member shouldn't herself be doing something wrong or illegal. Okay, so this next rule is in the form of a limerick that I made up. I thought it was quite good, and I hope you do too. Here goes. Long before the apple fell on Isaac Newton's head, heartbroken lovers knew gravity could kill you dead. You can forget about gravity, but it remembers you all the same. If a grazing sheep falls off a cliff, it's the shepherd who's to blame. Basically, this rule is saying two things. Ignorance of the law is not bliss, since even if you don't know about the law, it still applies to you. And secondly, whenever you delegate work to a subordinate, you just delegate the work. You retain the responsibility. You want to go through that again? Okay. Ignorance of the law is not bliss and certainly not an excuse. And even if you don't know about it, the law still applies to you. And secondly, delegation does not mean abdication. And whenever you pass work on to a subordinate, the responsibility for their overall supervision, the quality of their work, and compliance with applicable laws and regulations is still yours. That's it. Now read the limerick out loud to yourself one more time, just to let its message sink in, and also because it's my first bit of poetry and I really, really want you guys to like it. Rule number 5. Hansel and Gretel. Lay your trail of breadcrumbs for yourself and for others. Okay, so this rule applies mostly to the actions that a member takes in relation to clients, whether they be investment actions or recommendations or communication with current or prospective clients. However, the rule can just as easily be applied to the work that the work that the member does for her employer. The idea here is that all actions, communications, representations, recommendations, etc., should be solidly based on fact and factual analysis. Diligence and care must be applied in the analysis of all such facts and in the gathering of these facts, and that the solidity of the analysis as well as the diligence and intelligence of the analysis must be defensible and supported by a paper trail of work showing that the member's application of due diligence, thoroughness, and care while preparing the recommendation or representation. Or, more simply put, and this again is a lesson more for life as well as it is for the CFA Level 1 exam. The member must know what she's going to do. She must tell people how she's going to do it, then do it, and be prepared to explain why she did it. Rule number 6. If you have it, don't flaunt it. It's not who you are underneath. It's what you do that defines you. Okay, so this rule relates to the use of the CFA designation. The CFA Institute discourages and prohibits all unnecessary glorification of the CFA Charter, and all references to the CFA Charter should be kept strictly objective and factual. Statements or references such as a member saying that I am a CFA Institute Charter holder, or that I have cleared X number of CFA Institute exams, so that makes me an expert in international investments. Statements like that are strongly discouraged. The member may be an international investments expert, or she may not know the difference between calls and puts. But the fact of the matter is that she's cleared X number of CFA Institute exams, and that's all that she's allowed to refer to. Just the fact that she has cleared X exams, and not what, in her opinion, those exams have turned her into. On a related note, the CFA Institute also requires that members not be referred to as CFAs, and they shouldn't refer to themselves as CFAs either, but in all cases as CFA charter holders. The idea is that the CFA designation should not be objectified, but rather it should be used as an adjective to describe a member, not to define the member. Rachel Dawes, who plays Bruce Wayne's main squeeze in Batman Begins, she has this down pat when she explains to Bruce that it's not what does she say? She says it's not who you are underneath, it's what you do that defines you. Of course, at the time that she says it, Bruce is emerging dripping wet from a hotel swimming pool, accompanied by two similarly drenched girls. So he has a hard time convincing Rachel that he isn't all bad, but also quite a lot of bat. But the point remains that people are people first, CFA Institute members second, and so members should be referred to as CFA charter holders, not as CFAs.
So, here they are, the CFA Institute Code of Ethics and Standards of Professional Conduct, decomposed and distilled into 6 easy to remember rules called the Rules of My Way.
And mind you, these rules just aren't applicable for the CFA exam. Most of them find plenty of traction in real life as well. We've itemized them here, and we recommend that you write them down, learn them, and understand very well what they all mean and represent. One thing that they do represent is a reduction in size. And in the student world, like in the spy world, size does matter, but it's the opposite of the real world. Small is good. I am, of course, just paraphrasing from the movie I Spy, starring Eddie Murphy and Owen Wilson. It's a fun comic kind of movie, and even if you've watched it several times, it still isn't a bad watch with pizza on a slow weekday evening. Check it out sometime if you haven't already. Okay, in this next section, which is actually quite a lengthy section of this video series, we map the rules of my way that we just introduced over the CFA Institute's Standards of Professional Conduct. This will firm up your understanding of the rules of my way and how they work in practice in relation to the Institute's code and standards. And it will also check for the sufficiency of the rules of my way vis-a-vis the Institute's, so that you can be sure that learning and concentrating on the rules of my way does not in any way mean that you're missing out on any aspect of the Institute's standards of professional conduct or code of ethics. And we also take this opportunity to then talk about soft dollar commissions and the mosaic theory. For non-practitioners or for people just starting out, these may be new areas. But since these are important areas, not just for the level 1 exam, but also for investment life, we will give a walkthrough of how the rules of my way address them. Before we start, you should have hard copies of the Institute's code and standards at hand, and also a hard copy of the rules of my way. Well, Standard 1A basically requires 3 things of members and candidates. First, know the law. Second, obey it. Third, do not be party to or help in violations of the applicable laws and rules. My way rule number 4, particularly the bit about Isaac Newton, gravity, and heartbroken lovers, addresses points 1 and 2, that the law applies to you whether you know about it or not, and you're required to obey it at all times. While my way rule number 3 specifically lays out the protocol of disassociation in cases where the member can become a party to or aid or abet in violations of law. Rule number 1 applies to the first couple of objectives too, but in a more general sense, that a member's lack of knowledge or lack of compliance with the law may hurt or harm the legitimate interests of the people the member was working for. And just as the member herself wouldn't want to be the victim of someone else's shortcomings, she should strive to ensure that her actions also don't cause any harm to the other members of the circle of life. My way rule number 1 encompasses all 5 of these standards and applies to all situations which these standards were designed to address. Standards 1C, 1D, and 3D are straightforward. The member should ensure that her behavior with other members of the circle of life is such that she wouldn't be disappointed with it if she were on the receiving end instead of being at the giving end. And just as the member wouldn't want to be misrepresented to or dealt with dishonestly or deceitfully, she should refrain from doing the same to others. Standards 1B and 3B basically require that in all their professional activities, members perform and present work that is analytically or factually unvarnished and free from someone else's biases or self-interests as well as their own. That is independent and objective. That is being independent and objective. And just as the member herself would like to know A, the truth, and B, the whole truth, and C, the best possible analysis of the truth, she should ensure that she delivers the same, nothing less and nothing more. Okay, so these standards refer to situations similar to the ones that we had discussed earlier, where a member may be pulled in two directions regarding her primary responsibility and may face distracting pressures due to conflicts of interest. As we had pointed out earlier, conflicts are a routine matter in a member's work in the investment world. A fund manager may be tempted to work harder and ensure better performance for those accounts which personally compensate her. Which provide her additional compensation over and above that provided by her employer, even if such efforts marginalize her employer or the other accounts that the fund manager handles. Members may also be tempted to sell high commission products to their clients, even if the products may not be best in class or what the client needs. Or a fund manager or broker may be tempted to front run her clients' security transactions, or an analyst may be tempted to recommend an IPO to her company because of the hefty commissions she's going to make off the company's IPO commitment. All these instances, and there are countless more like them, they can be countless more like them, represent conflicts of interest. And to address all of these, rule number 1 explicitly states, whenever conflicted, disclose. So, disclosure of the source and nature of the conflict is mandatory. After disclosing the conflict, the recommendations are basically the same as the ones on the previous slide. That is, to honor the hierarchy of the circle of life, to follow your primary duty to the best of your ability, to do to others what you would like done to yourself, and to save them from what you wouldn't for yourself either. Both these standards are talking about a level playing field, or rather the lack thereof. Standard 2A acknowledges that during the course of normal work from time to time, a member may come into possession of important investment information that is not at that point in time available to other investment market participants. Standard 2A requires that members not act on that information or help others to act on it. Why? Because it is unfair to other market participants, because it gives an unfair edge to the member over the general investing public. And just as the member wouldn't like her competitors or peers to profit unfairly at her expense, she shouldn't profit at theirs either. Similarly, just as the member wouldn't like to be on the receiving end of market manipulation, she shouldn't be on the generating end or the giving end of market manipulation either. We need to bring out two important points here, both of them related to Standard 2A. First, what exactly is material information? And it's important to know this because the exam may test you with a situation that may need you to decide whether information is material or non-material. So you need a test. Quite simply, material information is information that causes the price of a security to change. Quite usually, it is fundamental information about a company's operations or the industry in which it operates. And by the flip side of that coin, any information that is insignificant enough that it does not cause security prices to change is non-material information. Secondly, what about the use of non-material information that is also non-public? Well, the CFA Institute is a practitioner's institute and is practical in its approach to such matters. They recognize that investment professionals derive their decisions from a mosaic, and hence the name, the mosaic theory. That investment professionals, they piece together information. They piece together a whole mosaic using material public information, which may also include non-material, non-public information, such as interviews with suppliers or customers, or the views of industry experts, or how popular the company's brands or products may be. As long as the analysis does not include or is not based on material non-public information, then the mosaic theory says that working on non-material, non-public information is just fine. Loyalty, prudence, and care. Well, these are fairly subjective and nebulous concepts, so certainly here we cannot lay down a specific set of circumstances where these standards will apply. What we can do, however, is to state the obvious, that the member should treat her clients the same way she would like to be treated if she were the client and someone else was in her position. And that certainly would not entail being disloyal to them or working carelessly and imprudently for them. The same goes for her attitude towards her job. She should perform her duties for her employers as she would like them performed if she were the employer and someone else was in her position. As Robert De Niro immortally said in Goodfellas, never rat on your friends, which basically means that never be disloyal to your clients or to your employers. Essentially, never hurt the legitimate interests of all those who you rely on for your bread and butter, and do what is right for the others in the circle of life, especially those who outrank you in terms of hierarchy. All this considered together with Standard 5A, which requires members to be diligent and to have sound logical bases for their investment recommendations. It's quite apparent what the CFA Institute wants its members to do. It wants them to do a good job at investments, and regardless of whether they're doing it for clients or for their employers, members are exhorted from various angles and via various standards to perform their duties to the best of their abilities and to be prudent, careful, and loyal to their clients and employers. Ancillary to such duties of loyalty and care lies the small matter of soft dollar commissions. While soft dollar commissions brokerage is not a specific topic of study under the CFA Level 1 curriculum, it is a very real phenomenon in the investment world and is the subject of much regulation and scrutiny. And because it also frequently pops up on the ethics section of the CFA Level 1 exam, we're going to spend the next few minutes talking about it. Basically, soft dollars brokerage commissions refer to services that a broker provides its clients in addition to pure order execution services without explicitly charging for these services. The key word here is explicitly. The broker does not provide these services for free. He just does not list down explicit charges for these services. The commission rate that the broker receives from its clients will naturally be higher than for pure execution brokerage. But nevertheless, despite the higher brokerage expenses that the end client pays, the additional services rendered by the broker, they are not explicitly charged for, but are instead covered under the umbrella of brokerage expenses. Now, the additional services rendered by brokers are usually ancillary or complementary to investment services, such as providing sell-side investment research or organizing company visits, management meetings, investment seminars, or conferences. Such services ostensibly aid the clients in making better investment decisions and are considered ancillary to or complementary to investment services. Occasionally, however, the services may not be quite so ancillary, such as brokers paying for clients' entertainment or traveling expenses, or paying for some portion of the client's overhead costs, or other such services that you cannot call by any stretch of the imagination investment related. This is not such an issue where the clients are managing their own money, since it is their own funds that are flowing back to them via the broker in some form or the other. In fact, there is this thing called directed brokerage, in which clients can specifically instruct the broker to purchase goods or services on behalf of the client, even if those goods and services are not investment related as such. And in doing so, in the purchase of such goods and services, the broker can use the soft dollar brokerage commissions to pay for such purchases. However, in the case of pooled investment vehicles or third-party fund managers, where several investors have entrusted their funds to a third party, this becomes an issue. The use of soft dollar brokerage commissions becomes an issue here. Why? Because in this case, the fund managers may be enjoying the fruits of their investors' labor. How? Well, it is the investors' funds which are effectively paying for the brokerage expenses. And if those funds are being used to pay for the fund manager's traveling or the fund manager's entertainment or overhead costs, that is clearly not what the funds were entrusted to the fund manager for. The benefit of the commissions is not flowing to where the commissions originated from. The benefit of the funds is not accruing to the end investors in any way, and that is not right. There's too much grey in this area to call soft dollar commissions wrong or to outlaw them altogether, since sell-side investment research is a very important service that brokerage houses provide their clients. However, to strictly protect and further the interests of the end clients, you will find that soft dollar brokerage is the subject of much disclosure, regulation, and scrutiny. This standard is taken care of generally by rule number 1, meaning that the members certainly shouldn't engage in malicious disclosure of their clients' or employers' secrets with the intent to cause them harm. So that's the straightforward, simple case taken care of. For the slightly more nuanced, more tricky situations, we developed rule number 2. And this is where Mr. De Niro takes center stage.
You took your first pinch like a man, and you learned the 2 greatest things in life.
What?
Look at me. Never rat on your friends, and always keep your mouth shut.
Never rat on your friends, and always keep your mouth shut. There will be situations in life and on the exam where the disclosure of information about a client or employer may actually appear to be for the benefit of the client or the employer. And we'll soon see some of these situations when we tackle sample questions, where on the surface, on the face of it, disclosure actually may be for the benefit of the client or the employer. However, the rule says no. You always keep your mouth shut. The only situations where it is acceptable to divulge information about a client or employer are when such disclosure is required by law, or the disclosure is about something illegal or unethical, or the member has specific permission from their client or the employer to divulge that information. Any other situation, and you refer back to Mr. Robert De Niro in Goodfellas and hear what he has to say. The specific rule of my way created to cater to the requirements of the standard is rule number 4, especially the latter part of rule number 4. If sheep fall off a cliff while grazing, it's the shepherd's fault, not the sheep's. It's fairly straightforward to see the application of my way rules number 4 and 3 to the standard. Basically, to stop your subordinates from making mistakes and breaking the law, to ensure that they perform their assigned tasks as professionally and as well as possible, to take the blame for their mistakes, the ones that you couldn't detect or rectify, and if you're a good manager, give them all the credit for a job well done. This last part obviously is just good management. It's not part of the CFA Institute's standards of professional conduct. Rule number 5, whatever you do, leave a paper trail behind you, clearly showing your calculations, analysis, reasoning, methodology, etc. for why you did what you did and how you did it. That's the primary requirement for all 3 of these standards. That is a documentary chain that can be retraced by yourself or anyone else who should be checking or using your work. It can even be clients who should be able to understand your work and analysis and recommendations and also how you arrived at them. Rule number 1 is also applicable in a more general sense, in the sense that whatever you do shouldn't be so opaque that it cannot be replicated by someone else at your workplace, which is obviously unfair to your colleagues and to your employers. Whatever you say or whatever you do also shouldn't be so arcane or come across as so exotic that your clients have a hard time understanding what you're telling them and why. So to make life easy for yourself and for everyone else concerned, be they colleagues, employers or clients, the member should have proper records, formats, notes and records of analysis, etc. to make it easy for both herself and everyone else to understand what she is doing or saying and why. Don't be all flash, don't be all smoke, be fire. In other words, be Michael Jordan, don't be Dennis Rodman. No one can forget the guy who flew or the guy who ruled the NBA. While the weird outfits, the weird makeup, the weird hair, they're out of mind almost as soon as they're out of sight. Enough said. So here endeth the lesson, and what we've tried to show here is the 100% congruence and overlap and sufficiency of the rules of my way versus the CFA Institute's standards of professional conduct. We've also gone through all the rules of my way in detail and have explained their meaning and intent and applicability. So now it's time to talk about all that in exam terms. In the CFA Level 1 exam, the examiners present candidates with a choice of 3 answers to a question. For the ethics section in particular, and more generally for other topics as well, at least one of those choices is the straightforward elimination. It can be readily discarded. The choice between the remaining 2 is then not that straightforward and requires that you know your stuff, if not really well, then at least pretty well. What we're going to do here is to dive straight into some sample questions now and wade in and get our feet wet. Remember that unless otherwise stated in the question, all individuals in the following questions are CFA Institute members or candidates in the CFA program and therefore are subject to the CFA Institute Code of Ethics and Standards of Professional Conduct. Good luck.